Ladies and gentlemen, welcome to our investing podcast. Our guest on the podcast today is once again Jack Vogel from Alpha Architect. Jack conducts research in empirical asset pricing and behavioral finance and has a strong academic background, holding a Ph.D. in finance and a Master of Science in Mathematics from Drexel University. Dr. Vogel graduated summa cum laude with a Bachelor of Science in Mathematics from the University of Scranton, and his background also includes experience as an instructor and research assistant at Drexel University in both the finance and mathematics departments, as well as a finance instructor at Villalon University. Dr. Vogel is a co-author of Do-It-Yourself Financial Advisor, a simple solution to build and protect your wealth, and Quantitative Momentum, a practitioner's guide to building a momentum-based stock selection system. Without further ado, let's welcome Jack Vogel, and before we start our interview today, let's keep a moment of silence in the memory of famous investor Charlie Munger. Thank you very much. Welcome, Jack. I'm glad that we have the chance again to discuss the unfolding events during such challenging investing times.
Yeah, and I'm happy to be back on the channel.
Great. Then, to begin with, I would like to mention Warren Buffett's famous quote and ask you whether you consider diversification being protection against ignorance or rather against bad luck.
Diversification is definitely good for most people, is what I'd say, right? Because, in general, diversification is one of the free things investors can get by investing in diversified portfolios. And as that quote goes, or as the question was asked, right, it's protection against ignorance. I would probably agree with that, because a lot of times investors might not fully understand, potentially if they had a good investment early on in their investing career and think that they're just a great stock picker, when it could be the case that they got lucky. So I'd probably go with the ignorance side of that equation.
Great. You are probably familiar with the famous expression, when the US sneezes, the rest of the world catches a cold. What do you consider being the main benefit of international equity diversification in a volatile macro environment, given that during market drawdowns, correlations usually jump to 1?
Yeah, so there's definitely some benefit to international diversification, right? One is, to the extent the US dollar loses purchasing power, right? You could potentially benefit by having exposure to other markets. Secondarily, right, while the past, I would say 10 plus years, a lot of the, growth in the global economy has come from the United States. That's a fact, right? It's not always the case that it always comes from the United States. So you are diversifying at some level the geography from which global growth that actually gets passed through to shareholders, which is actually important, is driven from.
Interesting. But in terms of international diversification, a lot of people consider that by investing in US multinational companies, you're already getting international exposure by owning them, and you don't have to invest internationally. What do you think about that? Do US companies alone provide enough diversification through their international exposure?
Yeah, so there's some truth to that, in that some US companies get international diversification. And what I'd say is I don't take a hard line on one should be all US, all ex-US, right? On that specific question, I generally give the advice, if you're unsure, just use the market cap weights of said allocations, which actually are today is I believe around 70% US, depending on, if you're looking at US developed and EM or US and developed. One could take the more hands-off approach, say, I'm not going to overthink this. I'm just going to go with the global market cap weightings of US and ex-US. So I think that's always a good starting point for anyone before they make any bold decisions to go, either all US or all ex-US.
Very, very good answer, at least for a beginner, right?
Mm-hmm.
In a comment published on his Rational Reminder community blog, Ben Felix has mentioned that his prior belief has been confirmed that concentration is a suboptimal approach, but can make a lot of sense if you want higher expected returns than could be achieved with a diversified portfolio and you don't want leverage. If you were to choose, would you maximize expected or risk-adjusted returns?
Well, it's hard to quantify risk-adjusted returns on a go-forward basis, right? Because again, while in general the volatility of like market portfolios are pretty consistent over time, to the extent we're talking potentially about factor portfolios, that volatility can actually vary over time. So if you told me, I can't use leverage, which again was part of the quote. If you can't use leverage, I probably, depending on the horizon, I'm relatively younger compared to some people, I'd probably prefer expected returns over risk-adjusted returns, assuming one can't use leverage. So, but again, that's a more nuanced question, and the assumptions in that question you'd have to kind of outline to give a true answer.
Right. Do you think that investing in emerging markets equities is similar to buying a reverse lottery ticket like Ben Felix suggested in a Rational Reminder podcast, so that time works against you in the long run or rather in your favor due to increased equity risk premium?
Do you mind repeating that question?
Ben Felix was mentioning about a reverse lottery ticket. So that the more you hold these emerging markets equities, they become riskier, like let's say long-term bonds.
Yeah, so for emerging markets, I do think they are slightly different than developed markets, right? And it does depend on the governance, right? So like a lot of US investors, right? If you just invest in US companies, you take for granted that the government can't take your company, right? Whereas in certain EM countries, that may be an issue. In which case, you may be, if you are an investor in certain emerging markets, you may be taking on risks that as a default, like US investor, I invest in S&P 500, I don't even consider those risks, right? But now you invested in certain emerging markets and you may have taken risks that you don't even know about. So what I say is, investing in EM, one probably needs to like quantify and think about additional risks that are out there. And then obviously there's a trade-off. If you believe the returns are high enough to justify it, possibly it's worthwhile. But again, I would just caution everyone to kind of try to understand the differences in governance from US to, emerging market economies.
Yeah, good answer. From a valuation perspective, how expensive are global equity markets today?
Well, in general, one would say the US might be fairly expensive relative to the rest of the world, right? However, a lot of that is skewed by the so-called Magnificent Seven stocks. So what I'd say is it depends on where you are looking within markets, right? So if you just look at the US market cap weighted, one would say, yes, the US is, relatively has a higher value than it has in the past. And, developed and EM are cheaper. If one looks at, the US X, those 7 to 10 stocks, right? It's not as crazy. So, but again, remember, valuations have assumptions embedded in them, right? So if one wanted to simplistically say, hey, I'm going to try to predict expected returns, right? Because you want to invest just on valuations, you can essentially do that via 2 methods. One is just saying, hey, we're going to take in, the dividend rate plus the expected growth rate of earnings, right? That would be one model in which one could use. And in that model, the US isn't crazily overvalued. Now, if you use a second model, which assumes some sort of a mean reversion in multiples on earnings, you might believe that the US, is overvalued. But it's hard to predict, what's going to happen in the future. There's been studies saying that the US is going to have lower returns than international, I think going back since 2014. So we're in 2023, and that did not play out. And one of the main reasons that did not play out is that the U.S. actually had much higher growth rates of earnings than international markets. So again, when trying to predict returns, it is hard to do that. And I would just caveat, trying to use one model. You might want to, and if you do that, you want to have a good understanding of what the assumptions are in that model.
That's true. What do you think about comparing valuations through time? Should they require a cost of capital adjustment like the Fed model coined by Ed Yardeni, which compares the earnings yield to the current treasury yield, or not?
Well, yeah, I mean, there's some research papers. Cliff has a paper discussing the Fed model, and whether or not that is accurate for predicting returns. What I'd say is, in general, there probably needs to be some adjustment, right, or some assessment, because at the end of the day, investors are going to have trade-offs, right? So if you told me today that the U.S. Treasury wanted to issue debt at 20% risk-free, that might be a reasonable alternative to stocks trading at 20 times earnings, right? So while the predictive, while it's hard to predict future returns of stocks, I do believe that a cost of capital should be adjusted over time. And if one, the basis for valuation, right, when one just learns, hey, I'm going to try to value a stock or value a equity that I'm investing in, well, one of the most important inputs into that model, right? So you have your cash flow growth is the numerator, right? But the denominator is the discount rate. And we know that the discount rate varies over time. So yes, I do believe that one should adjust for the discount rate over time. How predictive that is of future returns, I'm not sure about that. But one definitely needs to adjust the discount rate if it varies, because it does over time.
Do intangible assets help explain the gap between US and international valuations? And what do you think about US stock market outperformance? Could it be explained by the fact that US companies are better capital allocators or not?
Yeah, so I'll answer the first one. The first one was about intangible assets explaining valuation differences, right? So, what is an intangible asset? Just maybe define that. So an intangible asset is an asset that a firm has that can potentially help it through branding or through growth of earnings. That's just my very quick definition right here. But an example would be like Starbucks, right? So Starbucks book value of assets, at least as of a couple of years ago, haven't looked this year, was negative, right? And you might be like, well, that's kind of crazy, right? how does that occur? But everyone knows, if you go to an airport or you're in another country and you see the Starbucks logo, you're probably going to get some level of coffee, whether or not you like that or not, right? It's pretty consistent. So there's a value in that logo. So that would be an example of an intangible asset, right? And so, there's some research papers highlighting that these intangible assets, as we moved away from the industrial economy, right? Intangible assets aren't being valued on balance sheets. So there is probably some value, there probably is some truth to the fact that intangible assets would account for valuation differences, right? Like as I just mentioned, Starbucks, on a book to market basis, you might say is expensive. If we account for the logo and we put a true value on that, potentially, which is not done, but potentially that would help bring that gap closer. Right now, you asked the second question about, can that? I believe the question was, can that explain the return differential recently between U.S. and international? And on that, what I'd say is, I go back to something I said earlier, which is, the U.S. earnings growth has been very high, right? And those Magnificent Seven companies have actually grown legitimately earnings at very high rates, right? So if you think about it, well, what have these companies done? So Facebook, let's just go through a couple of them, right? So Facebook, what does Facebook do? In general, makes a lot of money because it has super hyper targeted marketing, right? So if you think about it, the marketing budget for every company, small, large, medium, across the entire world, can actually very accurately target people via Facebook, right? What did Apple do? Apple created a whole new market, which was smartphones, right? In 2006, there was not smartphones. They created a product that now is everyone uses, right? Microsoft has grown its, user base. And, if we went back 2005, you'd buy Microsoft and, you'd buy a one-time thing. You'd have your computer for 5-10 years. Now, a lot of it's subscription-based. So they have these recurring revenue models. So again, those are just three examples. AWS, right? I'll end after this one, but AWS, they basically do cloud computing. So if you had an entire IT team in the back end, now you can just outsource that and hire AWS. So those companies did legitimately grow earnings via solutions in the market. So what I'd say is a lot of the U.S. growth over the past, 20 years was driven by, some of it was driven by those mega companies. A second thing that sometimes gets overlooked is the governance differential between U.S. and international, right? And what do I mean by that? Governance is just how is a firm governed, right? One of the interesting facts, when I spent time getting a Ph.D., read a lot of papers about corporate governance in the U.S., and one of the strands on literature was about pay for performance, right? And what this research was about was if boards incentivized CEOs to grow earnings, they saw that the stocks did better. And in general, almost every U.S. company, the CEO is highly, highly, highly incentivized to grow earnings. I don't think it is the same exactly in international markets. So, there is a governance differential that I think had some impact. What the percentage is, I don't know. But I do know almost every U.S. CEO, if they grow earnings, they're going to make a lot of money.
So basically, do you think that US companies are better capital allocators because they reinvest that cash instead of paying off dividends like most EM companies do?
Yeah, so dividends, capital allocation decisions, it's really this. I'd say what it is the CEO is incentivized to make the most accurate decision, right? So in general, like again, you pay out dividends. Well, I guess if you already have a dividend policy in place, you're probably going to continue it, right? Because discontinuing a dividend is generally not liked by the market. But what I'd say is, if you have a company that you believe, pretend you had $10 billion of excess cash after you pay off everything. So your free cash flow is $10 billion. Well, if you can invest $5 billion of that to return 20 billion in the future, of course you should do that, right? That's a super high rate of return. If you can't do that and you don't really have good use for that cash, returning it to shareholders via buybacks, via dividends, potentially that's a smarter use of capital. So what I'd say though is the governance, like the CEOs in the US are incentivized to make accurate decisions. At least from what I've seen, by the way, a lot of CEOs are compensated in the US.
You mentioned dividends and earnings growth. And I would like to ask you, what do you think are the main flaws of dividend growth investing strategy, which is a very popular approach for retail investors?
And you said, what's the main flaw?
Yeah, the main disadvantages, let's say, of this strategy, pursuing this strategy.
Yeah, so again, I wouldn't say dividend and dividend growth investing is bad per se, right? I think sometimes people, so academics would say, dividend investing is not a factor, right? And you might say, well, why? Like, why would that be the case, right? And one of the main reasons is because, again, when academics are trying to like understand what's called the cross section of returns, why some stocks do bad, some stocks don't, right? What you have to do is put inputs into your model, right? And one of the big issues with dividends, using that as a variable to explain returns, is that, let's just say, about half of the companies don't pay dividends, right? So what happens is you have, 50% of stocks with zero variation, like their value is zero, and the other 50% have some dividend value, right? So that's actually bad. Like in general, if you have a variable that you're trying to use to explain cross-sectional movements in stocks, you don't want to have 50% of the companies have the exact same value, right? So that's why in general, from like an academic perspective, academics would say, well, dividend investing is just subsumed or better explained by value investing, like buying cheap stocks, right? Now, dividend investing in and of itself, right, is not horrible per se. You're going to tilt your portfolio towards generally value stocks, right? What I'd say is, investors should be wary, and this is borne out in a lot of papers, but should be wary of, number one, like not having enough diversification in the portfolio. We talked about that earlier, right? Like I wouldn't invest all of my money into one dividend paying stock, right? If you do that, maybe that's good. Unfortunately, I've talked to investors now as I've been doing this, someone who had General Motors stock because it paid a good dividend, that went to zero. Someone who had General Electric stock because that paid a good dividend, that went down a lot, right? So in general, you want to diversify, number one. And then number two, you want to, look for potential risks for each of those stocks for a reason the company might not be able to pay a dividend at some point, right? Because, in general, if you're investing in a stock mainly for the dividend, you want to have a good understanding as to why that company is going to have recurring cash flows. So I wouldn't say it's bad necessarily, dividend investing. You're going to tilt towards value stocks. So maybe there's a better allocation, which would be just investing in value stocks as opposed to dividend stocks. But dividend investing in and of itself is not bad as long as you're diversified well enough.
I'm not sure what happens if a stock stops paying off dividends and it's a dividend growth stock. Do you sell it or what happens then?
So in general, the market does not like that, right? So I think there's at least one research paper I read back in the day highlighting that, when firms discontinue dividends, they tend to have pretty bad at what are called like abnormal returns as measured of the stock performance over like a 3-day span compared to the market or compared to a set of peer stocks. So in general, when firms discontinue dividends, that's not good. If you are an investor like in a dividend model, dividend growth model, or dividend ETF, generally the manager or yourself would have to get rid of that stock from the portfolio.
Yeah, it's well known that dividend yield is a very poor value metric. However, I heard this argument from dividend growth investors that they don't believe in the Miller and Modigliani theorem because in real life there's no efficient market or perfectly efficient market, and therefore their strategy is better.
Yeah. So better, worse, that's hard to define. What I'd say is everyone should probably start with a basis of markets are pretty efficient, right? Not perfectly, right? That's just a fact. There's always going to be some anomalies, some overreactions, but the market is pretty efficient, right? And so, if you said, their argument is that their investment strategy is better, right? Well, it's better than what, right? It's like that's a hard question to ask. And then we can say what's better, what's worse. What I'd say is dividend investing, dividend growth investing, as I said earlier, it's not a bad strategy per se. Like I wouldn't say that, right? You're investing generally in equities. Okay. Equities historically have had a premium over bonds and a premium over bills, right? So that's good, right? You're tilting your portfolio towards value stocks. Okay. Historically, value has had a premium over, growth stocks. So, it is a reasonable strategy. Again, one just needs to ensure you're like diversified. Now, it's going to lag the market at times, right? Like past 10 years, a dividend investing strategy would have lagged against the market. So one, we could say, well, is that better? Vanguard would say, well, you should just invest it in the market potentially. Or, like a Boglehead type investor. But what I'd say is it still is a reasonable strategy to be a dividend investor. I prefer to tilt towards just pure value, like from my perspective. However, that doesn't mean dividend investing is bad.
I'm not sure how well diversified can you be since most dividend growth stocks are located in US. And we come back to the previous question I had about international diversification. But let's say, is there any rule of thumb for allocating into small cap value equities, like a certain percentage to start from?
Yeah. So small cap value, a lot of investors prefer if they use value to tilt towards small, right? And there's good reasons for that, right? When one looks at the historical premiums to value, which is the long short factor, like in an academic perspective, if one looks at long short value in large caps, it's a lot smaller, the premium, or negligible compared to the long short value factor return and premium in small cap stocks, right? One caveat to that, and I actually have a paper that was published last year, looked at if you take large cap stocks. So most investors, right, we don't invest, like I would say probably most investors who you ask the question, what's the percentage one should have for small cap value investing, right? Well, most investors who are doing small cap value investing are not investing in this long short factor, right? You are just buying small cap value stocks. And so actually, I published a paper last year looking at long only value investing. And I said, if one is a small cap value investor, how does that do compared to investing in large cap stocks, but just equal weighting your positions in large caps, right? So we're not going to market cap weight. And what you see is the returns are actually similar, right? If you do large cap value and equal weight compared to small cap value, the returns are actually statistically insignificantly different, right? They are essentially similar. So the question is, how much should one invest in small cap value? Well, small cap value historically had a good premium, as did, large cap value equal weight, but you are going to take tracking error from the market, right? So again, it really depends. One just needs to understand that if you're going to all of a sudden compare your portfolio to the S&P 500, you should just invest in the S&P 500, right? Like it kind of has to be a trade that you plan on sticking with, because the premiums to value, both in large and in small, are time varying, and it's not the exact same time as equity market. So there's no perfect amount, right? If one was to look at the US, you would say, hey, large is 90% of market cap, small is 10%. Like that's actually the market cap weighting. So it'd be around a 10% weighting if you didn't want to overweight from the market cap percentages. But if one believes like small value or large value equal weight has is undervalued, you could overweight it. But if we just looked at S&P 500 weight compared to, the next 2,500 stocks, it's about 90% market cap would be the S&P 500, right? The next maybe under 10% today would be small caps.
Sounds good. But from a valuation perspective, is it worth to diversify into small cap value stocks and also have a large cap value tilt, or you should only keep small cap value? And also, is there any optimal tracking error you should take in your portfolio?
So tough questions. And again, so it varies depending on who I'm talking to, is what I'd say, right? So for example, like a financial advisor who is an intermediary between themselves and a client, that end client might not understand what tracking error means, right? But at the end of the day, the advisor knows that this client is going to compare that portfolio to the S&P 500, right? And so in that instance, I'd probably recommend, hey, let's start, at least 70, 80% the S&P 500. The other 20, 30%, let's tilt towards, smart allocations, such as like small value or large value equal weight or momentum or some sort of other smart factor investment, right? If we're talking individual investors, right? Individual investors who believe, that the portfolio is like diversified enough and has a, smart strategy to it, right? It's not just me throwing darts at a board. It's a factor strategy, potentially towards like value or momentum. One could overweight that, right? And so I'd say it just varies depending on the investor. But if you do overweight, you have to understand it's going to perform different than the market. And then tracking error, right, will depend on the strategy itself. So for example, we run some strategies that happen to have, tracking error, let's say of like 15 to 18% compared to the market. There are some other firms that run variations of that, right? So, Dimensional is one firm that runs a variety of factor investing strategies. So their small cap value strategy is going to have a really high tracking error. Their core strategies are going to have a tracking error of like 1% to 2%, right? So even they have like a tilt and a continuum across which investors can pick. It's going to vary from investor to investor, unfortunately. Who knows what the future will hold, but in general, if an asset class gets undervalued, that could be good in the future, but how much one should allocate there is really a investor by investor decision.
Do you think that an investor should overweight small cap value stocks by default, or only if they are cheaper than large cap value stocks?
So, again, historically, one should have just tilted towards small value or large value equal weight, held it, never done anything, right? But it is time varying, right? So, and again, there's just the investor understanding of the strategy. So obviously from 2000 to 2004, 2005, small value, large value equal weight, anything not the market looked amazing, right? But the preceding 6 years, if you had done that, you would have lagged the market by a ton. So in general, like, I'm a fan of factor investing. So I personally, tilt my portfolio towards value. Like if we're saying, hey, here's the market portfolio, I'm tilted definitely towards value investing. However, I understand that there are going to be times that I'm going to underperform the S&P 500 and the market, like in my personal account. But yeah, historically, one would have been best off by just keeping that allocation, not overthinking it. On a go-forward basis, who knows what'll happen? But historically, there was a premium to owning value.
Yeah, that's true. And by the way, right now, EM equities versus US equities are at 50-year lows. Some argue one should check the relative earnings chart instead of relative price difference. Do you think that relative valuation gap between regions can be used as an argument for overweighting EM equities, or may rather be an indicator of low expected earnings growth?
Yeah, well, number one, if you're going to compare regions, I do believe you can't just use price, right? So one should use potentially, if we were going to make an argument to overweight a region based on some sort of measure, I wouldn't use price. So valuation is a measure to use. Now, as I talked about, right? And this was one of my previous answers when we talked about like expected returns, right? EM might be cheap for a reason, right? Because you could have low expected growth rates of earnings relative to the US, which might have higher expected growth rates of earnings, right? And again, like the growth rates of earnings, this also goes back to the governance structure, right? So, for example, certain countries, you might actually achieve high growth rate of earnings, but the end question is, do those earnings, are they actually owned by the shareholders? And if the answer is no, we could just say, well, that it doesn't matter, right? Like, yeah, you grew earnings, but the government came in and took away the earnings, right? Or said, we're going to reallocate the earnings. So essentially, yeah, the growth rate of earnings that is achieved by the shareholders definitely should have an impact on a valuation differential, right? I mean, that's a fact. So yeah, I would say the growth rate of earnings achieved by shareholders definitely should have an impact on valuation differences across countries.
Interesting answer. I would like to ask you, how do you explain the low earnings per share for EM equities during the past decade, and if this trend is, let's say, reversible, like cyclical or not?
So I don't want to speak out of tune. So on the trying to explain low growth rates of earnings in EM, I'm not like an EM expert per se. What I'd say is, in general, U.S. companies just had very high growth rates relative to other countries. Why EM countries had such low growth rates, I don't know if I can give a great answer, unfortunately.
I was wondering whether we can expect some kind of mean reversion like it happens with valuations, also with earnings per share, or not. They are simply losing earnings per share growth.
Yeah. So valuations, like valuation or mean reversion, right? That does occur, right? So at times, right? So, it can occur one of two ways, all right? So a lot of people think, hey, valuations can mean revert because prices can come down, right? Alternatively, earnings can just keep growing, right? So there's two ways valuations can mean revert, right? Which is people could have underestimated earnings, in which case, the valuation ratio comes down because the earnings actually increased, right? Alternatively, right, like what we kind of saw in 2022 in U.S. markets was valuation ratios came down because prices came down, right? So there's two ways in which these things can occur. The question, though, was in EM, do growth rates mean revert? That I'm not sure about, right? I don't believe that it's the case that because EM growth rates of earnings were low, they are required to increase. So I'd be a little wary of using that as a line as a main line of reasoning to invest in EM companies. So I'd be wary of that, is what I'd say.
Yeah, maybe that's the risk of investing in EM equities.
Mm-hmm.
But is there any extreme market scenario when you would consider timing based on valuations? And the same question applicable for factor timing.
So generally, extreme's hard to define is what I'd say. In general, right? When risk is perceived to be very, very, very high, right? One way you could measure that would be like VIX, right? Another way you could measure that would be, potentially high yield spreads relative to, just double A or some sort of broad corporate index. In general, historically, if you looked at that, that would have been a good time to invest, right? Like you invested in late 08, early 09 when VIX was super high yield spreads were super wide. That was a good time to invest. If you would have invested mid-March 2020 when VIX was super high yield spreads, were blown out, that was a good time to invest. So what I'd say is if you see like a 4 or 5 sigma event in that, historically that worked. It's not guaranteed to work, but it kind of goes back to one of the Buffett quotes, right? You want to be, and I'm gonna mess it up because I'm bad at these types of things. But essentially, it's you want to be greedy when everyone else is kind of backing away, right? And you want to back away when everyone else is being greedy, right? Mm-hmm. But I do think that's a decent reason. So if one was like, hey, I have some excess cash, I'm going to invest, those are good times to invest. On factors, right? So that's answered your first question. The second question is, does it make sense to overweight factors at times? What I'd say is, in general, for the value factor, historically, when valuation spreads got very wide, that was a good time to invest. That's occurred multiple times in the past. I think it bore out recently, right? So book to market spreads got very wide in 2020, and those spreads have come down a decent amount, right? But they're still pretty high. So generally what I'd say is, on factor timing, at least for the value factor, right? And I picked that specifically because the value factor, you're always going to be in cheap stocks, right? So when that factor historically has gotten, very wide, that was a good time to invest. On factor timing, at least for the value factor, you're always going to be in cheap stocks, right? So when that factor historically has gotten, very wide, that was a good time to invest. On factor timing, at least for the value factor, you're always going to be in cheap stocks, right? So when that factor historically has gotten cheap on a valuation basis compared to growth, that was a good time to overweight, right? So if your default weight was 10%, or if it was 20%, potentially you go a little bit higher on those allocations. But it's not guaranteed to work in the future. But yeah, historically, that was a good time to invest in the value factor.
So basically, don't time the market, but you can see a little in value factor today.
Yeah, well, yeah. So the value factor right now is a little, I would say, the valuation differential between value and growth is pretty wide compared to where it has been historically. So it could be a good time to overweight value.
By the way, speaking about that, would you consider iShares value factor ETF a pure value fund, or rather an ETF with a multifactor filtering? Because they also have exposure to profitability, I think.
Which fund are you talking about?
iShares MSCI World Value Factor, let's say, which is also available in which is format for Europeans.
Gotcha. Yeah. So if you are trying to overweight value compared to the market, you probably are going to be better off just using a value ETF compared to multifactor, is what I'd say. Because multifactor generally takes into account, multiple things such as like profitability or quality, right? Potentially momentum, right? So the value ETF would be a more pure play on that strategy. You probably just want to real quickly understand how is value being defined, right? Within the fund. So yeah, if you wanted to overweight value, I'd probably prefer like a single strategy fund compared to a multi-factor. The multi-factor probably is going to have lower tracking error though compared to the market. So there's just trade-offs.
I agree. We always talk about EM equities as being cheap from a valuation perspective. However, how expensive are EM equities in terms of overall funds costs if we take into account also dividend drag and transaction costs?
So yeah, I guess it just depends on, from a US investor, I can get allocation of broad EM via Vanguard iShares pretty cheap, right? There will be a dividend. I don't know if I call it a drag, but there will be dividends paid out, right? Which potentially impacts like your after-tax rate of return, right? Because in the US, you have to pay tax on dividends. And then transaction costs. The transaction costs are going to vary just depending on the strategy that you're running, right? So for example, a momentum EM strategy is going to have very high transaction costs, right? A value strategy in EM, potentially using like book to market, which doesn't vary that much, is going to have much lower transaction costs. And of course, just buying the whole EM market is going to have the lowest transaction costs. So EM is definitely costs more to invest, right? Both on management fee and on transaction costs. But again, there's reasons certain investors might want to invest in there. So, but unfortunately, there are costs that one has to pay to allocate towards EM equities.
Indeed. I've heard this interesting idea lately of carry trade of investing in emerging markets. If the relative valuation stay the same, the edge should be on EM based on carry. Like what you earn if prices don't change, like a dividend yield or bond coupon. And I like to quote AQR's Dan Villalon, who said the following: the case we make for EM is a carry case. It's just that it is cheaper. We don't need valuations to mean revert for it to pay off. For US to continue to outperform EM over the next decade, we would actually have to see either earnings growth continue to surprise any kind of analyst consensus, or for the US to become even richer than EM. If the relative valuation level stays the same, the edge should be to EM based on carry. What do you think of this carry case of investing into emerging markets?
Again, we're just making it's what are the assumptions, and so some of the assumptions were outlined in what you just repeated, right? So it might be the case that EM does better, right? Based on those assumptions. But if those assumptions aren't met, EM might underperform. So with any model, with any like proposed trade on a relative basis, right? There's always has to be some assumption in a model that you're making. So I will be honest, did not read. I'd want to read like the full assumptions in that specific model before I make any judgments as to whether or not it's right, wrong, or give an opinion. But I think any investor who, let's just, again, like, what are we talking about here? We're saying, hey, let's just use world market cap weightings as our baseline, right? So let's just say it's, my math is probably not exactly correct, but let's just say it's 70% US, 30% ex-US. So if you're going to tilt away from that, right, and you want to have some logic behind it, you want to know kind of what the assumptions are in that model.
Yeah, that makes sense. Let's say you tactically asset allocate by investing in single country ETFs based on CAPE ratio. When will you consider selling or trimming your position? Would you take into account valuation, or is it a poor sell signal, let's say, or exit signal?
Did you say single
countries?
Single country ETF. Okay. Yeah. On that, investing based on CAPE and valuation generally is difficult, right? Like Russia was very cheap, last year. What I'd say is, if you're going to use such a strategy, I'd probably outline it ahead of time and make it like systematic, especially on valuation. So potentially you say, hey, we're going to do it once a year, tilt towards the 10 cheapest countries, right? I wouldn't recommend investing all of it in one country, as I just outlined potentially one of the risks to doing that, which was like Russia, just how that all played out. That probably doesn't happen in most countries, but it did play out, right? So that's a reason for, again, diversification, if one wanted to tilt towards cheaper countries.
Yeah, and we can also take the case of Polish equities right now. They have, I think, a CAPE below 10, but in the same time, I think research affiliates shows that their Sharpe ratio is very low. So I suppose you should take into account multiple valuation metrics and maybe some other factors as well. I don't know, for tactical bets, maybe population growth rates or debt to GDP. I don't know.
Yeah, I mean, a simplistic strategy would be you add a momentum type screen on top, right?
So a simple momentum overlay. Is there any good indicator for that you should use?
Yeah, I mean, historically, just looking cross countries, momentum, the ones that have done well tend to continue to do well. One of the downsides of that is there's a little bit more turnover in the portfolio, right? Because on a momentum basis, the U.S. might be the country you'd be allocating towards. And that's why generally we're fans of like value and momentum here. Because historically, both of those premiums have done well, and they tend to have a lower correlation from a long-only perspective than a lot of other strategies.
Yeah, you mentioned about turnover. How would you build a long-only valuation-based equity asset allocation for a low turnover strategy?
For what?
A low turnover strategy.
Yeah, we don't have any models that we recommend on that right now. what I'd say is it would be something I said earlier, like maybe you pick the top 10, 15 countries, allocate, but that's not how we built our strategies. Like, for example, our international strategy is on a stock basis, not like on a country basis. So we'd prefer to tilt towards value via individual equities as opposed to specific countries.
Yeah, that sounds good. I would like to ask you, which of the following do you consider more predictive for forecasting future expected returns? Portfolio characteristics or factor regressions, and why? And also the same question should apply to geographic tilts versus factor tilts.
Sure. So what's more predictive? That's like been an academic argument since the mid 1990s, right? So on one hand, you try to predict returns via like just simplistic book to market ratio or price to earnings ratio, right? On the other hand, we try to predict returns using, regressions or betas on loadings. The papers kind of go back and forth on this for as to which is better, right? There were a lot of research papers in the late 90s, early 2000s. There's some newer ones. One of them is like characteristics or covariances is the title of the paper. It's kind of a argument back and forth. We prefer to look at characteristics, right? Because it's just easy to assess. Whereas factors and regressions, the betas will vary over time. A characteristic I can just look at and tell you this stock is cheap because its earnings to price ratio or PE multiple is 5, right? As opposed to saying, well, it's got a beta on the value factor of 0.8 or 1.2. So we prefer characteristics over factors. And then what was the second question?
The second question was about geographic tilts versus factor tilts. What matters most? What kind of geographic exposure you have, or if you tilt your portfolio to value stocks?
That one's a harder one to answer. And I'll tell you why. So, like in general, if you tilted towards value internationally the past 12 years, you lost to a U.S. value tilted investor just because in general, the U.S. equities did better than international. So that's going to vary over time. What I would say is I generally have all like I'm a fan of value investing. I'm a fan of momentum investing. The U.S. international allocation amongst the two is one I don't have a hard specific line on, which is how much one needs to put in U.S., one needs to put in international. That's why, I always just say, let's just start with market cap weights for U.S. ex-U.S. for how much to allocate.
Okay, but based on valuations today, would you have like a default allocation, or it's still the market cap weighted one?
I'd still probably recommend, like, again, it just varies. Like if I'm a financial advisor, I can't go all EM because if the U.S. stock market goes up,
yeah,
right. If the U.S. stock market goes up 40% the next 3 years and EM is flat, you're going to lose your job. The client's going to end up firing you. They're probably then going to hire like a bad, they're going to hire someone else, right? And on net, everyone loses in that scenario. For an individual, you can tilt towards what you believe are cheaper markets. But again, like, why are you tilting? So again, this goes back to the earlier question where you asked about like EM or international, and international is cheaper. EM's even cheaper compared to the US, right? But there may be a reason that it's cheaper. And the reason that would be is there are lower expected growth rates of earnings in those markets. So if I said, hey, the U.S. earnings growth rates in my value portfolio is going to go by 10% a year. Like that's just the US value stocks, their earnings growth rates, again, just in a hypothetical example here, they're going to go by 10%. Well, that should be at a higher multiple of earnings today than if my international value portfolio, which I only believe is going to go at 3% a year, right? So there is a reason at times that multiples in US and ex-US are going to be different. And that's why it's hard to say how much one should allocate, towards US, ex-US, because there isn't assumptions for earnings growth rates embedded into these multiples. Is it going to be right? We don't know, right? If international has higher earnings growth rates in the future than are expected today, and US has lower, yeah, international is going to do better because they're really cheap, or they're cheaper than US, and people were wrong about expectations for the future. So that's why I don't generally recommend like going all in on one specific thing, because there's generally reasons for these things to occur, and the biggest thing is expected growth rates of earnings.
Right, and not to mention the geopolitical risks. What is going to happen if China invades Taiwan? Maybe Chinese equities vanish like the Russian ones.
Yeah, that could happen. Like, who knows? We don't know. But yeah. Mm-hmm.
So if you take into account valuations from a fiduciary standpoint, is there any maximum percentage you would allocate to emerging markets, like, I don't know, GDP weighting or some other metric? I know the Federal recommends only maximum 20%, I think.
Yeah. I mean, I don't know about the fiduciary logic there, right? Because, there's U.S. fiduciaries that invest all in U.S. There's U.S. fiduciaries that invest all in international. So I don't know, this goes back to what does that word actually mean, right? But what I'd say is I do think there are additional risks in certain EM countries that people just discount and don't fully understand. I know if I invest in general in U.S. companies, in general, the government's not going to take those earnings, right? That's actually pretty much the case in developed markets, right? So then when you go to EM, there is additional risks where there could be potential like government interference into the earnings in certain countries. So what's the correct fiduciary answer? I don't know. But one also can invest in, like, there are solutions out there where it's like, hey, we're going to invest in EM countries that don't have some of these risks or are trying to minimize some of these risks. So it just varies on what our definition of EM investing is. Like, if it's broad market cap, well, you have those risks in certain countries. If it's like a strategy that actually tries to minimize or exclude those risks, well, yeah, maybe that allocation makes sense. Unfortunately, I'm giving you a non-answer on a percentage here, but what I'd say is I think anyone who does invest in EM countries should try to understand that there's potentially additional risks compared to US and developed markets.
That makes sense. But you mentioned about characteristics. Which characteristics do you find the most relevant for capturing exposure to value and profitability factors?
So for value, like, we're fans of enterprise multiples, right? Which is, operating earnings divided by the total value of the company. That's our preferred measure for value. Profitability or quality, that's going to vary, right? From like the definition of that. Novi Marx is like gross profits divided by assets, which is revenue minus COGS over assets. And in general, those are two good baseline measures. Like, the academic value of the academic measure of value is book to market. We prefer enterprise multiples. So it's just going to vary. What I'd say is there's just going to be differences. Book to market's going to overweight financials. It's going to overweight energy probably for the next forever amount of years. Enterprise multiples will at times overweight other segments of the economy. So, an investor can actually potentially like get diversification even amongst value if they use both, right?
Speaking about factor investing, would you choose between multi-factor over single factor funds, and also between smart beta long only factor ETFs, factor tilted ETFs, and long short market neutral funds?
So someone might prefer multifactor if they don't want to deal. So multifactor is going to have less tracking error than single factor. That's just definitional, right? Because multifactor, what's going to happen is when you combine all these signals, you're generally, right, depending on the methodology, but generally you're going to have less tracking error. And that can be good or that can be bad, right? So, and that also can be the case if one is not really sure, like what factors they really want to use. Multi-factor might be better. If one prefers to be a value investor, well, yeah, obviously single factor is better, right? Now, for most investors, they are going to pick long-only funds over long-short funds. Why? Because when they invest and they're saying, hey, I'm going to invest my money in equities, and maybe I want to invest in equities but value, or invest in equities but small value, right? They expect that to grow with the market. And the single most important factor in any model is the market, right? And so if you do long short, you are essentially trying to take out the market factor, right? So most investors are going to use long only compared to long short because when they invest, they expect the money to grow with the market.
Yeah, that's true. I know that also Larry Swedrow recommends long only for equities and long short for multi-asset funds. By the way, recently multi-factor ETFs had negative alpha. Does intercept matter when forecasting expected factor premia?
Well, again, it can. The intercept can vary depending on the model in which you use, right? So I can run a multi-factor model and compare it against a 3-factor regression, and it might have a positive alpha. Then I throw in a 6-factor regression and it has a negative alpha. And then, by the way, it's also going to vary over time. So what I'd say, though, is you probably want to, assess funds, look at what model you're using. In general, right, that negative alpha will account for potentially some of like trading costs as well as expense ratio that are embedded in the fund, right? Because again, when you run a regression, the assumptions on all those factors are there's no transaction costs, right? So those do occur within funds, but the alpha for predicting returns, I don't know how indicative that is. What I would say is I'd be more concerned if I'm trying to assess a fund and I said, hey, this fund tells me it tilts to value and size. I'd be more concerned if that fund didn't have loadings on value and size when it tells me it has value and size. Because the intercept is going to vary over time, and even the betas on value and size are going to vary over time. But if a fund tells me it tilts towards value, size, momentum, like a multi-factor strategy, it should have loadings on those.
May intercept vary from deviating from a market cap weighted fund like equal weighting sectors and not from factor loadings?
Yeah, well, there's going to be an interaction that goes on behind the scenes, right? Because the factors themselves are all market cap weighted, right? Like the momentum factor, in like the high momentum's market cap weighted, the low momentum's market cap weighted. Values market cap weighted, growth market cap weighted. So even though there is a size factor, right? Sometimes there is that interaction term where a value strategy that like equal weights, right? There's going to be an interaction term whereby it's possibly not picking up all of the variation, and that could get picked up as a negative alpha. Whereas just the definition of the factor is market cap weighted, not equal weighted. And if we equal weighted those factors, you'd have a lot less negative alpha, and a lot of that would get picked up by the right-hand side beta. So, yeah, I mean, generally, there will be variation depending on which model you use and how you build your factors.
Coming back to diversification, in a world of elevated inflation and increased macro volatility, would you consider US long-term treasuries like right now, given that they are yielding 5%?
Well, again, there's just trade-offs. Like you had asked earlier, should we adjust cost of capital? Yeah, of course we should adjust cost of capital, right? So U.S. Treasuries are potentially valuable for certain types of investors. It's hard to give recommendations to anyone without truthfully understanding their situation, right? What I would say is for potentially like retirees or people who are retired in the U.S., you went from potentially allocating towards bonds and getting 1% 10-year to 5%. I think it's like 4.3 today, but a much higher rate. So it's definitely on a go-forward basis better to invest in treasury bonds today than it was at the end of 2021 when interest rates on the 10-year were down by 1, right? And one of the line of reasoning there is historically in like developed bond economies, your 10-year return on a 10-year bond is generally around where the starting interest rate is. So 5% compared to 1%, yes, that's a better alternative. Is it the best for everyone out there? No, not necessarily. Unfortunately, I can't give direct advice to everyone because each scenario matters.
Right. Jack, given that you already hold a Ph.D. in finance, I would like to ask you if you had to choose the title of your Ph.D. thesis, which would that be from the following options? Evidence of factor premium in emerging markets, A. B. Innovative strategies for increasing the level of financial education. And C. Effects of unconventional monetary policies on capital market asset prices.
What was C?
C was the correlation between monetary policies and capital market asset prices, and A was about factor premiums in emerging markets.
I'd probably go with A or B. Factor investing was a decent amount of my thesis, but I do find B valuable. Mm-hmm. In general, increasing financial literacy. So I'll probably go with A, but B is definitely valuable.
Great. Do you still think, if you were to retire from working today, that this whole idea of financial independence is still reliable? Let's say, given the reduced equity expected returns going forward?
And so are you saying, can you maybe rephrase that question?
Yeah. If you were to retire from working today,
mm-hmm.
How sustainable do you think this idea of financial independence is in a world of reduced stock market returns? And I've seen that the safe withdrawal rates has already decreased from, I think, 4% in US to 3%. Some even speak about 2%.
Yep. Yeah. So that's where That's where you're correct. Safe withdrawal rates generally I would say, are lower today because it's probably the case that expected returns are lower. But what I'd say is expected returns are also time varying, right? Like if one invested, like I said, in mid-March 2020, you actually had very high future expected rates of return, right? Assuming earnings were going to come back up. So that's why what I'd say is there's a couple ways you could adjust that. Number one would be you adjust your withdrawal rate depending on kind of market environment, right? So obviously, if your savings, is not enough to, like, if you there's obviously a limit. You can't like go to zero potentially for all people, but you can vary that over time. So in a good market year, potentially you pull more out. In a bad market year, potentially you pull less out. That's one way that you could adjust to lower rates of return. The second way is potentially build portfolios whereby you might have some part of that portfolio that potentially could do well or might offset equity reductions. And one of the reasons to have that is, potentially, let's just say hypothetically, we had this perfect asset, right, which had like very little drag on the portfolio. But when the markets went down, it went up, right? That's what everyone loves. And we all try to seek for that. And there's strategies out there that try to do this, right? Whether or not they work, it varies. But if you put some of that in the portfolio, what that could allow you to do potentially is when markets get lower, you'd be able to then reallocate more money into risk potentially. And so that's why, yes, it potentially is harder to retire now than it would have been in the mid 80s when risk-free rate of return was 15% or 12% in the US. That's not what it is today. But you can try to minimize some of those risks by varying your withdrawal rates or building portfolios that potentially can buffer these types of drawdowns.
Yeah, I agree. Now, based on your experience in the markets, if you could teach the average investor one lesson, what would that be?
That's a good question. I'd probably say if you're younger, to just every month invest in general in equities that are going to have a long-term premium and try to not worry about the variation, right? If you just do it and say, hey, I put $100, I was able to save $100 a month, for 30 years, and you just invested in equities, you generally are probably going to end off pretty well in 30 years from now. So in general, it's just invest, number one. But number two is that, equity markets historically have had a premium. And so investing in equities for very, very, very long time periods, which I'm talking about for younger investors, is actually not that risky, is what I'd say. There's obviously risk to it. Your portfolio might get cut in half, but over a 40-year time window, that's probably going to be a better inflation hedge than keeping your money in cash or putting it in bonds.
Yeah, as Warren Buffett has once said, bonds are riskier on the long term than equities.
I would probably agree with that sentiment with a million caveats, but yes.
Jack Vogel, thank you very much for joining us today. It is always a pleasure to discuss with you the unfolding events in the capital markets and benefit from your insights from the markets. I will also want to thank all of you who have watched our show today and wish you Merry Christmas. Why not a happy Santa Claus rally for the end of this year? And after all these years of pandemics and wars, may 2024 be a better year for us all. Thank you very much.
I second that.
All the best for now. Goodbye and Thank you very much.
Thank you. Thanks for having me on.